In the context of a coffeehouse chain, consider the scenario where an individual has invested their entire savings of $100,000 and acquired a loan of $100,000 to launch the business in 3 locations within a city. It is expected that within 3.5 years, the loan will be paid off, and the initial investment of $100,000 will be recovered. Following this, profits generated over the next 1.5 years were saved to establish 2 additional links in the coffee chain. With the accumulated profits, it was feasible to open 1 coffee house. However, to open 2 more, additional capital was required. In order to avoid high loan interest rates from a bank, the entrepreneur sought the assistance of a friend who was willing to lend the necessary funds of $200,000. However, instead of paying interest and principal, the friend would own a 30% stake in the coffee house. Consequently, the friend acquired 30% of the ownership of the coffee house with $200,000. The friend's return on investment was then dependent on whether the coffee house would be successful or not. Individuals who invest in innovative concepts and transform them into businesses are known as angel investors. However, when a business expands and requires significant investments, it is a significant risk for a sole investor, such as an angel investor, to invest in such an idea. This is due to the fact that if the idea fails for any reason, the investor will incur significant losses on their share. In contrast, if 100 to 1,000 people do the same, the business concept will meet the necessary investment, and all investors will divide the shares based on their respective share percentage. If the idea fails, the loss will be divided among 100 people. To pursue such an offering, the company must satisfy market standards, after which people will begin investing in the firm. The stock market's foundation begins with a small idea or a business plan that evolves into a small-cap company ready for growth over time. In the stock market, companies are classified into 3 primary categories based on their turnover. Large cap firms have a market value ranging between $10 billion and $200 billion. Mid-cap firms have a market value ranging between $2 billion and $10 billion, and small-cap firms have a market value ranging between $250 million and $2 billion. Once a company is listed in the stock market, and if offers 10% of its worth as smaller pieces, each of these small units, known as stocks, has a value at which the company trades. For instance, if an individual possesses 5 coffee chain shops worth $1 million and requires $100,000 to expand further, they may request $100,000 in exchange for a 10% stake in their company from thousands of people. Now, you will divide this 10% of your company into 100,000 pieces. Such a division is called a stock. The value of each stock is $1. This means a person in the stock market can trade for 1 stock if they pay you $1, and you will share the profit percentage on that stock with them. The stock market is where interested investors meet a company they want to invest in. The Securities and Exchange Commission, SEC, regulates all transactions to prevent scams and ensure trades work smoothly. The role of the SEC towards a company is to check all its documentation and balance sheet, to keep track of all the stocks, the protocols of the state governments, and more. It also checks the investor's background and details before opening their DMAT account. A DMAT account is a separate account linked to the bank account that is opened by the regulating federal agency, through which all the trade and transactions occur. A DMAT account is different than a regular bank account. It holds 2 things, money and stock. And with a DMAT, you can unlock all the qualities of the stock market.